Good afternoon, everybody. Hey guys, it's been a while since I've done one of these live, but I felt this was pretty important. And I've literally gotten like a dozen Facebook message, a whole bunch of texts and things like that. And I wanted to clear the air and make this really simple to understand. So, my personal opinion, I think the media needs to stay out of real estate and mortgage lending and banking because this is two major things now, 2 weeks in a row that they've gotten majorly wrong. So you're seeing a lot of headlines that, hey, if you have a better FICO score, you're going to pay more for your mortgage as opposed to if you have a lower credit score. That's not true. And I just want to break this down in very simple terms how it works and what it means. So every single loan out there has what is called loan level price adjusters, or LLPAs for short. And what those are is based on risk. If someone is determined more of a risk by Fannie Mae and Freddie Mac, who are Fannie Mae and Freddie Mac, they're like mom and dad of the mortgage industry. They're the two biggest agencies on the secondary market that lenders and banks have their loans basically taken care of on the secondary market. So they're like mom and dad for the banks and the mortgage industry. And they basically sit there and say, hey, this loan is more of a risk as opposed to this loan is more of a risk. And let's just take a look at some of those simple things that there are. Down payment. If someone's putting down a substantially larger down payment as opposed to someone that's putting down a less of a down payment, they're less of a risk. So they're going to get rewarded with less fees and their mortgage being less expensive. And then the next biggest one is credit scores. Okay. So all Fannie Mae and Freddie Mac are doing right now is they are trying to lessen the gap of someone that has a 740 credit score getting a home loan as opposed to someone that might be having a 630 credit score get a home loan. That's all it is. So here's an example and an analogy I like to use with all my clients that just explains it very simply. If you have a twin, if I have a twin, let's say there's Aaron and Darren, and Aaron's got a 750 credit score and everything's the same. We make the same, we work the same job, we make the same income, we have the exact same debts, all that stuff. However, twin brother Darren has not been that good at paying his credit on time, or he had some things that might have happened that have caused him to have a lower credit score. So he has a 630 credit score. So traditionally, Fannie Mae and Freddie Mac are like, hey, you're more of a risk than your brother Aaron. So you're going to pay more to get the exact same interest rate as your brother Aaron because he has a 750 credit score. So I just want to show you guys a quick example here that I'm sharing my screen with. So this is based on a $300,000 loan amount, and they're putting 20% down. That's what 80% loan to value means. So on this purchase price, they're doing a 20% down payment. And so what this means is the person that has a 640 credit score in this example is going to be paying significantly more than if they had a 740. So if they're putting 20% down, their loan level price adjustment at a 640 is 2.25% versus 0.875% for a 740. So that means if you have a 640 credit score, they're having to pay 2.25% in additional fees or points, and a point is going to be 1% of the loan amount. So between those two of a 740 and a 640, it's a difference of 1.375%. So that means the person that has a 640 credit score is going to be paying 1.375% in points to get the exact same pricing or the exact same interest rate as the person with the 740. Okay. So if you have a good credit score, you are not going to be penalized for having a better credit score. They're just lessening the gap as before. So a couple months ago, in this same scenario, instead of paying 2.25%, that person might have been paying 3 points or something of that nature to get the exact same interest rate as they're doing now. That's all it is, guys. Very simple terms, but the media wants to create chaos. Guys, the media's number one job is to create ad revenue. That's it. So when it comes to buying a house or buying real estate, make sure you talk with your local real estate professionals. Make sure you talk with your local lenders that can explain this and understands. Because I promise you, there's going to be people out there that see that headline and they're going to go and purposely pay a credit card late thinking they're going to get a better deal. Nobody wants to see that, guys. Continue to pay your bills on time, just as normal as you would, and things will be fine. Again, they're just trying to make it more affordable for everyone. They're trying to open it up a little bit more and make housing more affordable and make getting a home loan more affordable. That's all it is, guys. Guys, if you know someone who could use this information, please feel free to share it with them. If you have any questions, please give me a question or a like and a comment and let me know. I hope everybody's having a wonderful, wonderful Monday and stay safe out there. Talk to you soon.